What's going on, guys? Mike here. In today's episode 4 of the Wealthsimple portfolio, and we actually had a significant increase in subscribers this past week, which is awesome. Thank you for everyone that has subscribed. And like I said, I just want to take a little bit of a step back, just kind of recap the goals of this particular series on this channel, just so everyone has the same understanding. So the goals of this particular series is to evaluate DIY investors such as myself and compare to a traditional bank mutual fund. And the reason why I'm doing that is because I always ask myself, well, if I actually didn't make this choice to do DIY investing, would have I been better off, right? Or is it actually a good thing to do, right? You just never really know because there's so many factors of emotions that are now involved compared to just set and forget to a mutual fund with a bank. You just your money transfers, you don't really think about it, you don't make any changes or anything like that, and it just grows, right? Well, this is the primary reason. We're going to see if we can outperform a bank mutual fund, and there's the mutual fund that I'm choosing is RBF 460. That is the fund that I used to be in, and that's why I'm using this one as my benchmark, because I made the change. So we're going to see if it pays off in the long run, and hopefully it brings some value to you guys. So after we kind of just I do also want to just recap from February 28th as to what the performance differences were, because this series did start after that. And we actually haven't compared that yet, but luckily leading into April here, we will get an update as well to see how we are doing. So we got to make sure we know where we're coming from and where we're going. So also on top of that, we're going to quickly have a peek at the week's performance of both RSP and TFSA, and also have a quick look at Plaza REIT because they have significantly dropped this week. So we need to have a look and see why that actually happened. Maybe you guys are also investors in Plaza REIT, so it's just always good to kind of stay informed. So without further ado, let's get to it. So you'll see here on my portfolio tracker here, I have the date set from December 31st to February 28th, because like I said, I did want to just quickly recap what the performance that we had compared to the fund that I'm benchmarking myself against. So you'll see here the year-to-date return was 4.2% as of February 28th, and you can kind of see pretty much everything in the portfolio was up, right? We had VDY, which is my high dividend Canadian ETF. We had my real estate that was up. We also had my global ETF, which is XEQT. Bonds were up, as well as my high interest savings account, which I obviously wouldn't expect that to go down at all. So like I said, totaling in at 4.2%. So looking at the RBF 460, this is the mutual fund that I used to be in. You can see here, this is as of February 28th, 2023. Their year-to-date was 2.8%. So looking pretty good, right? We're at 4.2. This one particularly is at 2.8. So it's not an exact spread, but this is primarily the reason why. I have specified it in another video of my why I moved to DIY. But this particular fund charges nearly a 2% expense ratio. So you're basically starting at negative 2% every January 1st, compared to the holdings that I have in my RSP. I actually only pay 0.18%. So significant yearly charge differences, which obviously help me, say it's a lot easier to potentially beat this fund because I'm not paying 2%. And I'm holding a lot of the same type of investments in this fund in my RSP. So like I said, 2% MER, so 4.2 versus 2.8, that's awesome. Now there is some little key differences I just want to quickly highlight on my RSP DIY versus this fund. Is my DIY is 90% equities and 10% bonds, where this particular fund was 60% equities and 40% fixed income or bonds or that kind of thing. So we need to realize that, right? So I actually have a little bit of a suspicion that leading into the next update, this we might not have as far as a spread. I think that they could be potentially just beating us, or they're just behind us. And that's because bonds in the last couple weeks have actually increased quite significantly. And so, is that going to bridge that gap? Possibly. Now, as we need to remember though, this particular fund being more of a balanced with the bonds in these types of situations will probably outperform me. But I do believe though that long-term equities do return more value in regards to capital growth. So long-term, I don't think this is going to be a normal trend. So this particular next update coming up, I do feel that spread is going to be a bit smaller between the DIY and this particular RBC fund. So just keeping it on the RSP, I'm just going to kind of update these fields here to just reflect this past week's performance. So we're just going to quickly update it here. Again, this is just based off of the our RSP contributions. So yeah, we're looking at about a 1.5% increase. Funny enough, bonds actually went down. People seem to be funneling back into the equities again. So maybe this is the difference that we're actually still going to come out on top next update on the portfolio. But you can see my VDY was up, REITs were up, my global ETF was up, but yeah, bonds were down. Now this one actually came, the high interest savings account came in as 0.3%, but that's just because the ex-dividend date was just announced. So they went from $50.20 back down to 50 because they're paying out that 20-cent dividends as the interest accumulation. If you don't know what a high interest savings ETF is, definitely check out the link here in this video to get more information on that. So yeah, going a little bit further here, we're going to look at the TFSA. We had one particular stock that did kind of go down. It did kind of rebound this last week here, or sorry, this last day, which is PLZ, which is the real estate REIT that I have. But you can see here I did 1.7. And another thing to kind of just quickly realize here too is that I have 0 bonds in the TFSA versus my RSP being at 10%. And my RSP does have like 15% cash holding, right? So just kind of, it does, well, I guess the cash holding is in the PSA ETF or the high interest savings ETF. So it kind of de-risks it a little bit. But you can see here, we did, by 0.2 score better on the week with a little bit more of an aggressive approach, but it also does have the opposite effect where it could also go down way more than my RSP as well. And you'll see that trend happen over the course of these updates where pretty much the TFSA is either outperforming the RSP or it's outperforming in a negative way as well. So again, we're gonna have to see, after a whole year here, which one actually performed better. So you'll see here the real estate REIT here went down 1%. We had tech go down 1.7%. Energy, which is my Enbridge, is at 2.2. Financials, a bit of a rebound. Last week we hit like all-time lows of like $77 on TD Canada Trust. This is that, and that's the stock I chose with financial. And it went back up into the 80 range. So again, 4.3%. Asset management being Power Corp, flat basically for the week. And then again, my global ETF, XEQT at 2.2. So yeah, so it was a little bit of a rougher week. We still gained 1.7%. But yeah. So what that does do though, let's just see if it can update. It might go up beyond here and come back and see if it's going to take a while to update. I'll come back here. So yeah, I do want to talk about Plaza REIT here though, because they actually did kind of have a bit of a stock dive. You'll see this change here. So yeah, from a month ago we were at $4.80, and now we're down to that $4.17. So the biggest reason why this is happening is if you go to their website under like their investing relations, they have like announcements. You can see here that they diluted about 8.5 million shares to gather up $40 million of capital. So that's obviously more shares in the market. It's going to bring down the cost. I do feel though like this is a pretty common trend for Plaza REIT. If you kind of look at their trends here, like they always kind of hover around that $4 to $5, and I haven't actually gone back to actually check this, but just by being an investor with Plaza REIT for just over a year now, it does seem like they hit that $5 and then they inject some more shares, and then it kind of brings down the value back down to that $4, and it kind of goes back up to that $5, and So me personally, and if you guys are also invested in this particular stock, I wouldn't necessarily expect like massive capital growth out of this particular stock. What you're looking for in this one is the dividends, right? Like one of the things I'm going to cover in my future series in this channel is like how I came across, like how aggressive and what do I need to gain for return on average to solidify my retirement. So what I learned when I did this assessment is I really just need to gain or to achieve basically a 5% return a year, because I'm only in my 30s. By the time I'm 65, if I get 5% average, I'm laughing for retirement. So that's really good, right? So when I look at this and it's like, okay, well, I can like lock in and get 6+ % dividends. That fits my goal right now. I do want some things that are higher, because obviously there's going to be years that do fluctuate. I need to hopefully capitalize on the higher growth so that it can offset the negative years as well to achieve that 5%. So like I said, a future video, I'm going to try going over, how I kind of came across like what I felt I needed to aim for. So I don't necessarily need to be like doing small penny stocks, or I would never recommend that, but very aggressive on trying to capitalize on like 50% returns or anything. I started young enough, so I don't necessarily need to be that aggressive. I really like investing in just like, blue chip dividend stocks, global ETFs that are just diversified, riding out the index for, returns kind of thing. So nothing too crazy. But yeah, so like I said, though, with Plaza REIT, back down to the $4 mark. Me personally, this is when I like to buy. I actually bought in when they were at $3.99 last year as well. And again, they went back up to that $5 range, and it's like, you could sell and take the profits if you were looking to put it into something else, but I pretty much just buy when it's low, and I just continually keep collecting that 6+ dividends, right? So that's my goal with this particular stock. So that's that. Other than that, I don't know if there's anything else. I actually haven't looked through this, but we do have looks like the SP 500 and the Canadian Global Manufacturing PMI. So that looks like that'll be coming out next week. That could have some fluctuations. I guess one thing that did come out this week that I did skip over is what was it? The GDP. So there's the results of the GDP. Friday's market went green. So obviously the market liked what they saw within the announcement of the GDP. So yeah, for next week though, like I said, the PMI, which is the manufacturing index. So typically when it's above 50, the manufacturing markets are expanding and growing. If they're below 50, then that means that they're contracting. So like, like the market is going the opposite direction, which I think is obviously what everyone's trying to achieve right now with this high inflation and all that kind of stuff. So I guess like I said, we'll kind of see what that kind of entails next week, and see what the market's going to react to that. I don't think I saw anything else kind of worth mentioning here. But yeah, like I said, I always just kind of like look 1 week ahead, kind of see what's kind of upcoming. But yeah, that's kind of like the only thing that I really saw is the PMI, which we'll have to see what happens here April 3rd, see what the markets think about it. So the other thing I just want to quickly highlight, and this is just kind of like a little extra to this video, is that when people are doing DIY investing, it's very important to always like make sure emotions don't get the better of us, right? So one of the things I always try to do is when looking, when comparing your performance to the week, right? Now this particular maybe is a bad example, but like, so you look at my TFSA just today, or Friday, sorry, I went up 0.7%, okay? You can see here on the TSX, which is the Canadian index, it went up 0.8, and the SP 500, which is just killing it lately, is up 1.44%, okay? So let's just pretend like this was the opposite. So you were down, let's say 0.7%. Well, if the TSX was down 0.8 and the SP 500 was down 1.44, it's like, yeah, it sucks that you're down, but when you're looking at like the world indexes, if you're just kind of following what they're doing, you're not necessarily doing anything wrong, right? So like, but let's pretend the green results here on the indexes are what they are, but I was negative 0.7. Well, that seems a little bit alarming, right? Because like you're doing the opposite of what just happened that day, and it's like, so why, right? Like, what are your investments doing as to why you're not following those indexes, right? So again, I always just kind of use it as a good way to like remind the emotions when it comes to DIY investing that as long as you're staying kind of with the indexes, that is a good thing. Unless your goals are to beat the indexes, then that's a whole other different strategy. But again, my strategy is not. I'm just looking to kind of follow. This particular week, like I said, the SP 500 has been kind of killing it. If you actually look at like the monthly performance of my Excel sheet here, the blue is me here, SP 500 is the red, and the TSX is the yellow. So you can kind of see that, like in January there, I was at 5.43%, and the SP 500 was 4.74%. So like that's really good. But like if that was inversed, right? It's like if I was down 5 and the SP 500's up 4, are you like investing in penny stocks? Like, are you buying super high, selling super low? Like, what are you, like, you got to ask yourself, like, what's going on here? So I just always use that as a good way to kind of refresh your mind as to, week to week, month over month, whatever you're doing. I find it kind of helps. But other than that, I think that's kind of all I got for an update this week. Some exciting news kind of coming up though. So first, April 1st kind of coming up here. We're going to have a series of dividends coming in for the first half of the month here, and a lot of the quarterly payers are also going to be paying out this month. So we're actually going to get some nice dividends on both RSP and the TFSA, which is kind of exciting. So we'll be able to go through and see. I didn't do any purchases or sells this week, just kind of left it. But like I said, this upcoming next 10 to 15 days, we're going to start seeing a bunch of dividends coming in from XEQT, TD Canada Trust, Power Corp. Like everyone's going to be paying out Enbridge. So it's really exciting. I like these end of quarter months, because then that's when you really get to make some changes. A couple $100 coming in from dividends is always exciting. Makes it feel like you're doing something right. So anyways, if you have guys any questions, definitely leave a comment below. If you like what you saw, definitely subscribe, hit like on this YouTube video. It definitely helps the channel, get it out there. But look forward to seeing you guys in the next video, and have a good one.